I want to talk to you for a minute about taxes. Now, here's the thing about taxes. Whether we're talking about Roth conversions or whether we're talking about payroll taxes or capital gains taxes and realizing them, there's a certain amount of taxes we're all responsible for and that we're going to have to pay. Hey, welcome. I want to talk to you for a minute about taxes. Now, here's the thing about taxes. Whether we're talking about Roth conversions or whether we're talking about payroll taxes or capital gains taxes and realizing them, there's a certain amount of taxes we're all responsible for and that we're going to have to pay. There's others that are optional. One thing I want to highlight here is when you take a potential tax and go ahead and pay it now, you're taking a potential future bill and turning it into a concrete current bill. That may or may not be the best approach. So something that we all like to do is defer our taxes, usually as long as possible. Now, when it comes to real estate, this is an area that I think is really key and has been underrepresented in conversations for a lot of folks. Many of us purchased property back in 2010 through 2014 during the economic downturn and got a really good deal on a rental property. You may have been renting it out for the past 10 or 15 years, and you're in a situation now where you're saying, okay, it's appreciated quite a bit. I'm getting kind of tired of being a landlord, but if I go to sell this, because I've been depreciating the property from a tax standpoint, and the value of the property has risen, if I sell it now, I'm going to have to pay a huge capital gains. Now, you may be aware that you can do a 1031 exchange and move that real estate into another piece of real estate, but that doesn't avoid the whole idea of getting out of the real estate market in general and saying, I'm tired of being a landlord, but I don't necessarily want to realize all of those capital gains at one time. Something you can consider doing is what's called a DST. It's a Delaware Statutory Trust. It's a way of doing a 1031 from a physical property that you're managing into more of an investment vehicle, and then you'll have an institutional investment properties that are held inside there. Kicks off a nice healthy dividend. And then after several years, what you're able to do is then roll from that kind of restricted DST into, you can do a second exchange. You can do what's called a 721 exchange. And then you can roll that into more of a liquid REIT, at which point you can do systematic disbursements and keep those distributions at a lower percentage to keep you in a lower tax bracket. And then you're not realizing that entire tax hit at one time. What also happens is, were you to pass away, your beneficiaries are able to receive that at a step up in cost basis. That's kind of the simplified version of what's going on. But if you're in that sort of situation, I think it's always worth begging the question of, do I need to pay these taxes at all? And if I do need to pay these taxes, what's the way to do it at the lowest rate possible? I think it's really key to remember here, there is a huge difference between tax avoidance and tax evasion. I'm not advocating for tax evasion. We don't want to do that. But tax avoidance, saying there's taxes that I'm choosing not to pay because I don't have to, I think there's a lot of value there. And I think it's really important to pay taxes on your own terms, when at all possible. When given a choice, let's do it when it's more advantageous for you, as opposed to at a time that's dictated either by market conditions or by just realizing it and saying we have to pay it in a given tax year. If this is something that you have more questions about, there's a lot of resources out there. There's a lot of ways you can look at it. But I would suggest talking with a financial advisor who can kind of coach you through the whole situation and give you a little bit more nuance, color, context. And what you may find out is the more you look into it, you realize, well, this is amazing. Or there might be some things where you go, this is a little bit of a hang up. Usually when something sounds too good to be true, it probably is. So it's always important to remember when we're looking at these, what are the downsides? What's the illiquidity? What's the timeline? What's the rate of return? What's the implications, not just for me, but also for my kids, for my grandkids? How are we creating that generational wealth? And how are we transferring it on in the most efficient way possible? I firmly believe as Americans, we have a responsibility to pay our taxes. As Christians, you see it as a biblical precedent. But I would also say this, nowhere does it say you should pay an extra 10, 15, 20% because you're not paying attention. Let's pay what we owe, but no more. Have a beautiful day. Hope you enjoyed this. Thanks for listening.